Number 15 down to 19. On June 30, PC Company purchased all the common stock of Silicon Company by issuing 100,000 shares of its 1 peso par value common with a market value of 25 per share. PC Company incurred 400,000 in registration and issuing costs and 250,000 in consulting and legal fees paid in cash. The book value of Silicon Company at the date of acquisition was 1 million, consisting of capital stock 560,000, retained earnings 280,000, and your treasury stock of 35,000, and accumulated other comprehensive income of 195,000 credit balance. The carrying values of Silicon's reported assets and liabilities approximate fair value, but it has 700,000 in customer list not reported on its balance sheet. In PC's journal entry to record this acquisition includes credit to additional paid-in capital for how much? So meaning the question is, how much will be the credit to additional paid-in capital, or includes a credit to additional paid-in capital? And we have now the answer of here, the acquisition price. So let's try to compute for number 15. Number 15. Investment in Silicon for 2,500,000. That's the investment in Silicon. 2 million. If you have to prepare the entry of PC. So investment in Silicon, 2.5 million. That's taken by multiplying 25 by 100,000 shares. Then we debit to expenses, 250,000. Credit to common stock, 100,000 at 1. So 100,000. Then we credit to cash for 650,000. That's the sum of 400,000 and 250,000. And the credit to APIC is 100,000 times 24 minus 400,000. Why do we need to deduct 400,000? Because the stock issuance costs are deductible from the APIC. So we have now your 400,000. So even if you do not prepare a journal entry, you only compute by multiplying 100,000 shares by 24, being the difference between 25 and 1. So that's 24. You get the amount of 2.4 million and deduct your issuance cost of 400,000. So your APIC is 2 million. That's the answer to number 15. In number 16, the entry to record this acquisition includes debit investment in Silicon equal to, you can already answer it, multiplying 100,000 by 25. So the answer to number 16 is B as in boy. Number 17, the eliminating entry includes, okay, that includes a debit to, if you have the elimination entry, a debit to accumulated other comprehensive income. So accumulated other comprehensive income in the amount of 195,000. If you are going to prepare the elimination entries, you are going to debit capital stock in the amount of 560,000. That's the capital stock of Silicon. Then you debit to retained earnings for 280,000. Debit to accumulated other comprehensive income for 195,000 and credit treasury stock 35,000 and credit to investment in silicon for the elimination entries, now amounting to 1 million. We also debit, we have other debits, customer list, debit goodwill for the amount of 800,000 and we credit to investment in silicon for 1.5 million. So all in all, the total credit to investment in silicon is the amount of the debit equal to 2.5 million. Now, what will be your answer to number 17? 17, eliminating entry includes a debit to accumulated other comprehensive income. 18, eliminating entry includes debit to goodwill for 800,000. Now that's the balancing figure. Goodwill. 19, eliminating entry includes a debit to customer list for 700,000. So 15 boy, 16 boy, 17 A, 18A, and 19 boy. Now we go to number 20. We are through with 19. Number 20. The company purchased 100% of the voting stock at Rage Company for 1.8 million. The following are the book and the fair values given: current assets, land and building, machinery, bonds payable, and goodwill at book value. Now, in the books of Rage Company, the bonds payable will appear on the consolidated balance sheet at how much? So 300,000 less discount of 50,000. That's why the net amount shown in bonds payable at fair value is 250,000. Considered to be discount is 50,000. So the answer to number 20 is B as in boy. Next, number 21. On June 30, 20X1, Noider Corporation purchased for cash at 10 per share all 100,000 shares of the outstanding common stock of the TED company. The total fair value of all identifiable assets of TED was 1.4 million. The only non-current asset is property with a fair value of 350,000. The consolidated balance sheet of Noider in its wholly owned subsidiary on June 30 should report. Number 21, the answer is, we multiply 10 by 100,000, so you get 1 million, and deduct 1.4 million. That's the fair value of the assets. So you got a difference of 400,000, a retained earnings balance that is inclusive of a gain of 400,000. So we now get the consideration transferred of 1 million, and we have 1.4 million. That's the fair value of the identifiable assets. So the only non-current property is uh, property with fair value of 350,000. So in number 21, we have a retained earnings balance that is inclusive of a gain of 400,000. Actually, it's a gain because the consideration transferred is greater than the fair value of the net assets. So number 21 is letter A. In number 22, down to 23, we are given the assets and as well as the liabilities and shareholders equity of NN Company on December 31, 20x4. On December 31, GG Company acquired all of NN's outstanding common stock for 1.5 million. On that date, the fair value of NN's inventories was 450,000 in lieu of the book value of 500,000. And the fair value of the property, plant, and equipment was 1 million. So one is over, the other one is undervalued. The fair value of all other assets and liabilities were equal to their book value. As a result of Gigi's acquisition of NN, the consolidated balance sheet should reflect goodwill in the amount of. So goodwill now is computed as 1.5 million minus 1,700,000 minus 50,000 decrease in inventories plus 100,000 increase in PPE minus 300,000 the current liabilities and 500,000 the long-term debt. So we have the difference of 550,000. It's in number 22. We have the amount of goodwill. It's goodwill because the consideration transferred is greater than the fair value of the net assets. If we have 1.7 million, we deduct 50,000 and then we add 100,000. So that gives us 1,750,000 and further we deduct liabilities amounting to 800,000. So the difference of 950,000, this is the net assets fair value. And if the consideration is 1.5 million, we deduct 950,000. The difference is 550,000. In number 22, it's the amount of goodwill. In number 23, assuming that the balance sheet of GG unconsolidated on December 31 reflected retained earnings of 2 million, what amount of retained earnings should be shown in the consolidated balance sheet of GG? So GG now, the amount of retained earnings is its retained earnings before the acquisition. So the amount is number 23. It's letter A. We go to number 24. Uh, the corporation acquired 100% of CC for 430,000. Immediately before the purchase, the balance sheets of the two corporations reported assets, liabilities, and shareholders' equity. At the date of purchase, the fair value of CC's assets was 50,000 more than the aggregate carrying amounts. So meaning the assets total exceeded the aggregate carrying amounts by 50,000. In the consolidated balance sheet prepared immediately after the purchase, the consolidated stockholders' equity should amount to, so we have now 1,250,000. That's the sum of the parents' common stock and retained earnings. So D as in dog for number 24. Next, number 25. Use the following information for question 25 to 29. The corporation acquired 100% of SS common stock at the date. The book values and fair values of the identifiable assets and liabilities were identical. Okay. Now, balance sheet data for the individual companies and the consolidated entity on January 1 follows. So we have now BB and SS, the consolidated entity, merely adding a BB's account balances with that of SS. However, you will notice that there are discrepancies. That like, for example, accounts receivable, you add 90,000 and 50,000. That's 140,000 in a, but in the consolidated balance sheets, only 130,000. The possibility here that the accounts receivable of SS was adjusted. The same with the land account from 70,000 to 50,000. Okay, question number 25. Assuming there were no inventory transactions between the companies, what balance for inventory should be reported in the consolidated balance sheet? So take note, inventory is 120 plus 90. So we have now letter D, assuming that there are no adjustments or no inventory transactions. 26. What amount did BB pay to acquire SS? Was this amount equal to or greater than or less than the underlying book value? How do you know? Okay, so we have now to determine in number 26. As shown in the investment account balance, uh, investment in SS Enterprise, you have the amount, a debit for 110,000 for the ownership of the parent to the subsidiary. The amount paid was greater than the book value of the net assets of SS and is reported as goodwill in the consolidated balance sheet at January 1, 2025. Now, how do we know that the amount paid of 110,000 was greater than the book value of the net assets acquired? If you look at common stock, and the retained earnings of SS, we have only 80,000, correct? So 110,000 a debit to investment in SS minus the book value of the interest acquired, adding the common stock and the retained earnings, totaling 80,000. So the difference is goodwill. So your answer to number 26 is A, 110,000. That's your amount in the investment account and it's 30,000 greater than the underlying book value. So 26, letter A. Next, we go to number 27. BB sold land it had purchased 12 years earlier. So we have now for 10,000 to SS. Immediately after it acquired SS, at what price did BB sell the land to SS? So you will notice that it was BB selling the land to SS. In determining the amount to be reported for land in the consolidated balance sheet, now we have stated the amount was sold for. uh, how do you know, no? How do you know that the amount involved here is equal to how much? Now, if you look at the land account, 70,000 plus 50,000, that makes a total of 120,000. How much was paid for the land as stated? If we have the debit to land of 70 and 50, but it's supposed to be 120, but the amount extended in the consolidated entity was only for 105,000. So the amount of 15,000 was eliminated. BB sold the land to SS for 25,000. That's the sum of 10,000 and the 15,000 difference shown in by adding 70,000 and 50,000. That's 120,000 minus 105,000. So the land was sold for 25,000. That's 10,000 the selling price, and the difference as computed above of 15,000. So in our answer, how much was the price paid for the land bought by SS? So the amount is letter C. Next, 28. What balance will be reported as accounts payable in the consolidated balance sheet? The amount to be reported is equal to, in the consolidated balance sheet, how much would be the amount to be reported in number 28? Okay, so we now get accounts payable 120 75,000 plus 55,000. Okay, now you get the total of 130,000, but you have to deduct 10,000 will be reported in the consolidated balance sheet. A total of 10,000 was deducted in determining the balance reported for accounts receivable. 90,000 plus 50,000, that's 140,000. We deduct 130,000. The elimination of an intercompany receivable must be offset by the elimination of an intercompany payable. So you will notice that accounts receivable, the total is supposed to be 140,000. However, the amount is only 130 ang gin-extend. So it is due to the intercompany receivable payable. Now we have the amount to be extended for accounts payable equal to 120,000. And 120,000 is letter D. For number 29, what is the par value of PP or BB common stock? The par value of BB common stock outstanding as of January 1, 20x5. So we have the amount of the par value, the common stock is stated at 100,000. You look at the common stock account, BB question mark is 30,000. However, we are aware that for the subsidiaries common stock, we eliminate in our elimination entries. So if we eliminate 30,000, but the consolidated amount is still 100,000, meaning that's the common stock of the parent. Okay? Now, in number 30 to 32. Okay, I hope we still have 10 minutes before again Zoom will end, but I'm going to. Okay, in number 32, number 32. uh, Here, the statement of Sun Corporation. So we have now the assets, the liabilities, and the share premium for the total of liabilities. All the assets and liabilities of SAM are assumed to approximate their fair values except for land and building. It's estimated that the land of fair value of 400 20,000. That's the land. And the fair value of the building increased by 96,000. Parent corporation acquired 80% of Sun's ordinary shares for 600,000. Okay. Only 80%. So, assuming the consideration paid includes control premium of 170,400. How much is goodwill? Using proportionate approach. So the answer to number 30, using approximate approach. Now, what's your fair value? The consideration. By the way, we are using the approximate approach, proportionate approach, so that the answer is fair value 100%, 600,000. The consideration transferred is 600,000. Book value of stockholders' equity is 180 plus 165 plus 90. 1,000, we multiply that by 80%. So we get 348,000. 348,000, that's the allocated excess. We are going to deduct over under valuation of assets and liabilities. So we have now the increase in land, 420,000 minus 264,000. And then you multiply that by 80%. 420,000 minus 264,000 times 80%. So that will be 124,800. And the increase in building 96,000 times 80%. So we now have 76,800. 124,800, 76,800. The total is 201,600, leaving us the difference of 50,400. That's your positive goodwill. The answer to number 30 is letter A, 50,400. Then we go to number 31. Assuming the consideration paid excludes control premium of 27,600 and the fair value of the non-controlling interest is 147,300. How much is the goodwill using the fair value basis? So how much is the goodwill using the fair value basis? We are now in number 31. 31. Now, the consideration transferred, is 600,000. Then the fair value of the non-controlling interest, is 147,300. And then we have the control premium given at 27,600. The total is 774,900. 774,900. Then we deduct the book value of the stockholders' equity with the book value of 180 plus 165 plus 90. That gives the total of 435,000. 435,000 deducted from 774,900. The difference is 339,900. That's the allocated excess. Then we deduct the over or the undervaluation of assets and liabilities. Increase in land, 420,000 minus 264,000 multiplied by 100%. So it's 156,000. Increase in land, 156,000. Increase in building, 96,000. Take note that in number 31, we are now using the fair value basis in computing goodwill. So we have now your positive excess. Goodwill is 87,900. In number 31, goodwill is 87,900. We go to number 32, assuming the consideration paid includes control premium of 44,400. How much is the goodwill or the gain on acquisition using full or fair value basis? So number 32, consideration transferred 600,000, we deduct the control premium of 44,400. So the difference is 555,600. Then we divide that by 80%. We divide that by 80%. So given is 694,500. That's 400%. 694,500. And then we add back control premium of 44,400. So repeat, consideration transferred 600,000 less control premium of 44,400. The net is 555,600 divided by 80%. So we have 694,500. That's the gross. We add back the control premium of 44,400. So the total is 738,900. 738,900. Then we add the book value of the subsidiary, 435,000. The same as above, 435,000 assumed to be full. So the allocated excess is 303,900. From 303,900, we are going to deduct the over or the undervaluation of assets and liabilities. So increase in land for 156,000. That's the difference between 420,000 and 264,000. So the increase in land of 156,000. Increase in building 96,000 times 100%. So the increase in building is 96,000. Add to the increase in land of 156,000. The total is 252,000, giving us an excess of goodwill 51,900. So number 32 is letter C. Next, number 33, we have the company purchased all of the shares of S company for 13 million. Now we are given the accounts prior to acquisition. The gain on acquisition in number 33 is equal to the acquisition cost is 13 million. Then from 13 million, we deduct the book value of the interest, that is the sum of 20 million and 36 million. So it's 56 million. 13 million, the amount of cost. 6 million is the book value. The allocated excess, so book value over cost, is 43 million. Then we add the existing goodwill given of 40,000. Now we get the allocated excess equal to 3 million. The allocated excess equal to 3 million. There is no over or undervaluation of assets and liabilities, so that the difference of 3 million, which is negative, that represents it's not a goodwill, but it's a bargain purchase gain or gain on acquisition. So we have the amount of 3 million is negative. Okay, now we proceed to numbers 34 to 37. Smart Company has 40% of its share publicly traded. PLDT Company uh, purchases the 60% non-publicly traded shares in one transaction. 7,560,000